Hello. So in last video we studied accounting ratios, or in accounting ratios we studied briefly the what is accounting ratios and what are the types of different accounting ratios. We briefly discussed all this. So we checked liquidity ratios. And liquidity ratio we see current ratios and liquid ratios. We studied both the ratios there in liquidity ratios, and we understood that liquidity ratios are those ratios which measures the short-term obligation paying ability of an entity. So now in this video we will go through some practical questions to understand the basic concept of how to solve the questions on this, and then we will also understand the application of the concept of accounting ratios and specifically liquidity ratios. So let's see certain questions, practical questions on this. And you have if you haven't gone through my previous video, so you may go through this to understand the basic concepts of accounting ratio. We will check this. So now let's see here some account questions we will solve. Okay, so we will now go through these practical questions. So that is the some first basic question, that's to understand how to calculate the current ratio, and we will go through the terms current assets, what are included in current assets and current liabilities. So I have also shown this balance sheet, T-type balance sheet in T format. So that will give you a basic idea of the how the different items of current liabilities and assets of an entity are presented there in balance sheet of a company or entity. So here a question is this: calculate current ratio and liquid ratio from the following details of AK Private Limited. So liabilities are given this side, and the liability includes you will see that liability includes debentures, long-term loans. So these are the long-term liabilities. And now short-term loan, sundry creditors, bills payables and outstanding expenses, these are the current liabilities. Okay, so now non-current assets are given here. These are the non-current liabilities. And trade receivables was short-term investment, prepaid expenses, inventories, cash in hand, balance in current account or bank balance, and bank FD and interest receivables. So these are the current assets. So these are your current assets. Okay, now what is the current ratio? We have seen the current ratio is current assets upon current liabilities. I will not solve this question here because that is simple to understand how to solve this question. So we will just first understand through this question the basic concept of accounting ratios, current ratios, and this liquid ratio. Now the current assets, these are the current assets. So when we will add all these items, we will get the item 2,50,000, 1,50,000, 55,000, 75,000. 80,000 is your cash in hand, 3,50,000 is bank balance, 2 lakh is bank FD, and interest receivable is 15,000. Total comes out to is 11 lakh some 75,000. This total will be 11 lakh 75,000. So I will write here that is 11 lakh 75,000. You can total it. Now we will see the current liabilities. What are the current liabilities? 3 lakh, 2,50,000, 5,50,000, 5,50,000, and bills payables are 2. So this 7,50,000 plus outstanding expenses, that comes 1,50,000. Total is 9 lakh. So this comes out as 9 lakh. Now when we divide 11,50,000 by 9 lakh, then we get a ratio of 1.30 is to 1. So ratio is 1.30 is to 1. This is the current ratio. Now the question asks you another ratio to calculate, that is the liquid ratio. So what we have seen that in liquid ratio, I just to revise you this, if you haven't seen this previous video, that liquid ratio here is current assets minus inventories. Why we reduce the inventories and then prepaid expenses. So this quick ratio calculates. So sorry, this is quick liquid assets. So I have to first write what is liquid ratio is. Liquid ratio is liquid assets, or you can also say quick assets and divided by the current liabilities. Okay, so it's okay to write this here. Okay, so now why we reduce current inventories and prepaid expenses. See, liquid ratio calculates the ability of an entity to pay its very short-term obligation. So in short-term obligation, we assume that we cannot realize inventories in a very short term time. Immediately, if we want to realize inventories, it is difficult to sell our inventories at optimum price in the market. And similarly, the prepaid expenses are those expenses we have already paid, so we cannot get back this money we have paid for expenses. In current asset we include because that in future time, in the next in coming accounting period, these expenses are already paid, so we need not to pay them again, and during the next accounting period we will be able to realize our inventory. So these are included in current assets. But as far as when we calculate the liquid ratio and calculate liquid assets, so these two items are removed from current assets. So this is the concept that inventories and prepaid expenses are to reduce, because inventories we cannot realize the inventories as and where we want to realize them. We need to depend the market situation, market conditions to realize our inventories. So when we reduce current asset, we calculated current assets, these are 11,50,000. Now when we go back to our question, 11,75,000, sorry, 11,75,000 was the current asset, and we have to remove or reduce from it 75,000 is our inventory. 75,000, that is the inventory, minus you will prepaid expenses. These prepaid expenses are 55,000. So we reduce it, and so it comes out to be 10,45,000. Okay, now the current liabilities remain the same. Why? Because the liabilities are something that we have to pay in short term. Like we cannot reduce liability, can arise anytime. So in a short time period, when the liabilities arise, we have to pay this liability in a short term time. So we cannot reduce anything. So we are measuring this ratio to our short term solvency to know the entity's ability to pay short term obligations. So these our liabilities remain there, we do not reduce anything from that. So this our current liabilities we calculated in our question. These current liabilities sometimes this pen is stuck somewhere. Liabilities are 9 lakh. So this is our 9 lakh, and now we calculate our liquid ratio. You see that is 10,45,000 divided by this is 9 lakh. So what you will get is use your calculator. I am using mine. So that is 1.16:1. This is the ratio, ideal ratio, you know. This is generally no 1.11. So this is how to calculate the. So this is the simplest question. Normally it is not asked in the examination. This is simple. I took this question just to get understanding of current ratios, current assets, current liabilities, quick assets, all these sort of things. So now we move on to calculate the solve our next question. That is, now we will start to go better difficult questions. So we come to our next question that says quick assets of a company are 1.5 times of current liabilities and 75% of current assets, and its current liabilities are 1,50,000. Find out what we have to find out. We have to find out the current assets, liquid asset current ratio, and liquid ratio means all liquidity ratios we have to calculate here. So what are the information provided in the question? First we have to write it down, so it will be easy for us to solve the question. So now we see that we have given this is quick assets. What the question says, read it carefully. Quick assets to current liabilities. Quick assets to current liabilities is equal to 1.5:1, and if you see, that is the quick ratio. Okay, so that quick ratio is calculated here because that is already given in the exam, in the question. Now this is the first information it is given. The second information is given is the 75% quick assets are 75% of current assets. What I am saying, current assets are 75% of current liabilities. We can write this like current assets, current assets. And the third information given to us is given the one current liabilities are given this there. Current liabilities here given is this is given to us is rupees 1,50,000. That is rupees 1,50,000. So now what we calculate first we calculate the quick assets. Can we calculate quick assets? Yes, we can calculate quick asset easily. Use this information here. So we multiply this 1.5 into 1,50,000. 1,50,000, this is current liability. So go read this point. Current liabilities will go this side. The quick assets will be, if you multiply it, use calculator, and that comes out to be 2,25,000. Now the second point is this: the quick assets are 75% of current assets. So can we calculate current assets? Yes, we can calculate current assets because the relationship is given to us. So important point is to note down these relationships in the examination in this type of question, because you have to use these relations. So this is the simple one. There are many other difficult questions. So you can identify how to solve the question when you write all the information in this. All the relationship should be written down in a very sequential manner, so that you can calculate the required ratios easily without wasting your time. Time is precious in exam, remember this. So now how to calculate this? I will go this will go to denominator. The numerator will be your quick assets. So you will write here 2,25,000 divided by 0.75. So it comes out to rupees 3 lakh. Okay, easy. Now you come to you have all the information available. You have current liabilities here, you have current liabilities, these current assets are here, current liabilities are here, and quick assets are here. So you can calculate the ratios easily. The first ratio, that is you want to current ratio. So what is the current ratio? Current ratio is your current assets upon current liabilities. So current assets, what are the current assets? And the amount of current asset is 3 lakh and the current liability is given is 1,50,000. So easily this is the 2:1. Now the quick assets already we know, and quick ratio were calculated already. So almost all things we have calculated. Quick assets here in the question, you see that we have done this also. Liquid asset we have calculated. Current ratio and liquid ratio is already given. So this is the simplest question that but the most of the questions are use your application and your knowledge of accounting ratios in this way. So these are the way the question in examination are asked.